Good day, good morning, good evening. It depends on the time that you're watching this recording. So this is an update to our online training course, which covers UK personal finance, and it's called Comprehensive UK Personal Finance Training. So I released this course in March of this year. So this update covers the period from March up until July. Which is about 4 months since I released the course. So if you bought the course, I had promised that I was going to make updates on a monthly basis, but things have actually been on my way. So I couldn't do the updates on time. But actually some of the months there weren't a lot of things to talk about. But anyway, here we are. So let's get started. So if you don't know me, so this is about me. So I'm a qualified chartered accountant, and I'm also a registered taxation technician in the UK. And I've also been working for top accounting firms in the world. So I work for EY and PwC, which is two of the big four firms. And this is the course that we are talking about in this update. So it's available on Udemy, and it goes for £19.99, which is cheap. It's equivalent to a price of a pizza. So yeah, right. And the whole purpose is to educate people about how to manage their finances. And there's quite a lot of things that I cover in that training course. So here, these are just a few bits where I'm updating, because as you know, with finance information, things continue to change now and again. So that's why these updates are necessary. So what are we covering? So these are the key updates. So the March 2023 spring budget, the Bank of England interest rates, the new tax rates for the current tax year, which started from 6 April 2023 and ending on 5 April 2024. And then Help to Save scheme, which is a scheme that I didn't cover in the training course. 0% deposit mortgages. So this is a new product which came into the market, and it's quite exciting news for potential home buyers who will be buying homes for the first time. And then national insurance missing years. So this covers instances where you wouldn't have been contributing for your national insurance on a yearly basis, that is making enough contribution. So again, I didn't cover that in the training, but it's quite useful information. And then we talk about housing schemes. So there are some housing schemes that have been extended and some that are ending soon. Then retirement planning. So I have a few updates for you on there. Portfolio diversification. So I covered diversification in the training, but I wasn't specific enough. So this is why I've decided to come up with this update so that I can specify things for you. And then some warnings about loan sharks, as well as frauds that are happening through AI, because over the past few months, artificial intelligence has been popular since the release of ChatGPT. So yeah, I'm going to warn you a little bit on there. And then lastly, the pension dashboard. So let's dive in. So March spring budget. So there are a few things there that I've put in that I think are necessary for you. So we'll start with pensions. So first thing is, which is good news for those with huge savings, or those who are going to be putting a lot more into their pension funds. So Jeremy Hunt decided to scrap the lifetime saving allowance. So previously this used to be $1 million. So once you would have accumulated $1 million in your private pension fund, then any contributions that you continue to make, you will be charged a tax rate on those, which was quite high. So as a result, that was discouraging people to continue working, because once they would have reached the 1 million threshold, then they'll be saying there wasn't any point for them to continue working, because most of their income would needed to be taxed. And again, that caused a lot of issues, especially from doctors, because some of them had already exceeded 1 million. So the good thing is the government decided to scrap the 1 million threshold, which means now you can contribute as and when you wish, still getting the normal tax deductions. Normally, when you contribute to a pension, it's deducted first before a tax rate is applied. So that has been scrapped, which is good news. And then the 25% tax-free allowance has been frozen at 268,000. So once you have reached retirement age, so if you have a private pension fund, you can take 25% of that pension tax-free. But now, since the lifetime allowance has been reduced, what that means is if this threshold hasn't been kept like this, it means that if someone had like 2 million in their pension fund, they'll be able to take 500,000. But the government has decided to still keep the threshold at 25% of the lifetime allowance. So again, the maximum that you'll be able to get is 268 once you reach retirement age. And also another good news as well, the annual pension allowance has been increased from 40,000 to 60,000. So this is the amount that you can put into your pension fund and still get tax deductions. So once you have contributed more than 60,000, then anything extra that you contribute, you won't be able to get any tax deductions, which means tax will need to be applied on your income before that deduction is taken into account. So let's say if you have earned 60,000 and then you make a contribution of 30,000 to your pension fund. So the 30,000 that you contribute is deducted first from your income before a tax rate is applied. So now the maximum previously was 40,000, but now it has been increased to 60,000, which again is good news for people who want to benefit from the tax deduction. And again, the tapered annual allowance has been increased from 4,000 to 10,000. So this again is a good news. So a tapered annual allowance occurs when, so let's say if you have reached retirement age. So the thing is, once you have started to draw from your pension, you are limited on the amount that you can still contribute to your pension. So previously, the amount that you can only contribute was 4,000, but now it has been increased to 10,000, because the whole point of this is to make sure that you don't benefit twice or try to find loopholes of saving on paying taxes. So that's why these tapered annual allowances have been implemented. And again, as a warning, all these things are because of the Conservative government which is in power. So next year, depending on what happens with the election, certain things may change. If Conservatives lose power, or maybe if a new Prime Minister is elected, okay? Right, then the next thing is childcare. So this again came as good news for people who are planning to have children or who already have children. So from April 2024, the government will be introducing 15 hours for free to cover childcare for children aged 2 years, and then they are planning to extend that to children aged between 9 months and 2 years in September 2024, which again is next year. And then in September 2025, the government will make 30 hours free childcare available for all children aged 5 years and below. So like currently, only children who are aged 3 and 4 can benefit from free childcare. Okay, and it's 30 hours of free childcare, and that 30 hours is based on your UK resident status. So if you don't meet the requirements, which we cover in the training, of course, your children will only be eligible for 15 hours of free childcare. Okay. So the reason why these things have been introduced is to make parents work more so that they can contribute into the economy. So again, this is good news. Right, next thing is the Bank of England base rate. So when I released the training, the rate was at 4%. That was in March, and since then it has been increased 3 times, which is good news for savers, of course. So if you have money in your saving account, you should have been seeing some interest or some notifications from the bank telling you that they have increased your savings rate, which is brilliant news. But again, this is bad news for borrowers. So again, if you have a credit card, you should have been receiving some letters telling you that the interest rates have been increased. I actually recently received a letter telling me of an adjustment on my credit card. So, right, but since then, the interest rate was increased 3 times, and it's currently at 5%. Again, this was as of 22 June 2023 when the announcement was made. But now a planned review is going to happen on 3 August, which is next month. So we will see what the Bank of England is going to do. So the effect of this, has been mortgage rates have been increasing significantly. So like now they are between 5 and 7% on fixed term mortgages. So which makes it difficult. I mean, if you want to buy a house at the present moment, it makes it a little bit expensive, and sometimes you don't know what to do, whether to go on a variable rate or whether to go on a fixed rate mortgage. So a variable rate is when your mortgage interest rate is adjusted based on the Bank of England rate. That is what we have been talking about here. And the fixed one is when the interest that you pay is fixed for a certain period. It can be fixed like over the period of your mortgage. It's normally fixed for a certain period, starting from a year or 2 years or 5 years or 10 years at most. So so it's a bit of a challenge in terms of making the decision which rate to utilize. So in that instance, then you might benefit from the use of your mortgage advisor. They'll be able to advise you accordingly. But again, the economy is difficult to predict sometimes. If you have money that is lying around, just make sure that you are earning the best savings rate. There are quite a number of providers who are paying a significant interest rate on there. So like at the moment, some of the accounts, they are paying even up to 6%, which is higher. So just shop around for products. Inflation. This must be good news, because when I did the training in March, the inflation rate was quite high. So it was 9%. But now, exciting news, at least it has decreased. It's now at 7.3%. So this is the consumer price index. So it has now started to decrease, which maybe is attributed to the increases in the Bank of England rate. Because the reason why that Bank of England rate that I just discussed has been continued to be increased is because the monetary policy committee has a target of keeping the inflation rate at 2%. So what they do is, for them to reduce the inflation rate, they have to increase the base rate. Because once they have increased the base rate, it stops people from borrowing and spending. And it actually motivates people to save. Okay? So because of that, in economic terms, the money supply, so that is the amount of money chasing goods, will reduce. And once the money supply has reduced, that will cause inflation to go down, because inflation is generally money chasing goods. So if there's more money chasing few goods, then the prices will increase. But again, this inflation was caused by a number of factors. One of them is Brexit, of course, which increased the cost of operation, and also the war in Ukraine, which also increased things like gas and oil. So, but now, at least there is light at the end of the tunnel of inflation starting to come down. So we hope the trend will continue. But unfortunately, UK still has a higher rate compared to like the EU. So the current EU inflation rate is at 5.5%. So the UK has a higher inflation rate. But at least there's some positive news on there. Right, let's go on. So because of inflation, the Parliament Select Committee on Business and Trade, so they actually decided to meet supermarket bosses, Asda, Sainsbury, and Tesco, to discuss the oil prices as well as the grocery prices. So if you have time to spare or to waste, being specific, then you can also look for this publication. But anyway, this was also on the news. That is, of course, if you missed it. But as you know, with politics, sometimes it's just more talk and no action. But I mean, remember, inflation has started to fall down, so we just hope the trend will continue. Tax rates. So these are now the current tax rates, because in the training we used 2022 to 2023 tax rates because the tax year hadn't ended. But so that these are now the new tax rates. So here I'm just going to talk through the changes. So if you are not aware, so Scotland sets its own tax rates, while other regions, England, Wales, and Northern Ireland, they use the same rates. But again, this is going to change in the future as the government continues to devolve power. So once those regions have the power to set their tax rates, they are also going to introduce their own tax rates. Okay, so UK excluding Scotland. So these are the current tax rates. So, and in terms of changes, so the additional rate, so previously you will be charged tax at 45% once you were earning 150,000 and above. But that now has been reduced to 25,140. So if you are those people who earn significant amounts of money, you should have seen a decrease on your net pay. And also, unfortunately, you won't be entitled to any personal allowances. So as you can see, that the personal allowance was kept the same as 12,570. So you won't get anything once you are earning more than 125,000. Okay. Then we move to Scotland. There it seems the taxes are quite high as compared to the other regions. Right. So same is around the top rate. So in Scotland they call that the top rate. So that again was reduced from 150 to 125. And then the higher rate. So previously it was 41%, but it's now 42%. Okay. And the top rate, it was 46%, but it's now 47%. And similar to what we have discussed around personal allowance, so that again you won't have any from 125,000 onwards. So yeah, so if you are one of those top earners, then yeah, it's bad luck for you. Okay, and then this table should look familiar. That is, of course, if you have bought the training, if you have done the tax section. Okay, so just a few changes on there. So the first thing is the dividend allowance. So if you have earned, so that is when, if you have earned any dividend income below, so previously if you had earned a dividend income during the tax year below 2,000, then you won't have to pay any tax on it. But now this has been reduced to 1,000 for this tax year, and the government again is planning to reduce that to 500. Yeah, because as you know, with the government, sometimes they try to look for nice loopholes for them to increase taxes where people won't complain that much. Because I mean, if they touched the tax rates, then that would be a news thing where people would be complaining a lot, and sometimes violation of their promises. But sometimes they try to touch on those smaller things. And then the other thing is on national insurance. So class 1B, which is what employers pay on employee benefits, so that has been reduced from 14.53 to 13.8%. And then self-employed, which is class 2, again, that was unfortunately increased because, again, this is paid by individuals, so that was increased from £3.15 to £3.45. So that's a 30 pence increase on there. Voluntary payments, that again is paid by individuals, so that's why it's increased. So it was increased from £15.85 per week to £17.45 per week. Then class 4, which is self-employed on profits, good news on there. So that was reduced from 9.73% to 9%. So we move on. Capital gains tax, again, no joy on there. So that was reduced from, so this is an allowance that you get whenever you sell any assets that is chargeable to capital gains, which they call a chargeable asset. So if you have sold like a property, in most cases, then you'll get an allowance, which means CGT won't be, capital gains tax won't be charged on it. So that was reduced from 12,300 to 6,000. And trustee allowance, so this is when a trust is holding assets and then that trust decide to sell a chargeable asset. So that was reduced from 6,150 to 3,000. No joy on that. Okay, let's move on. Corporate tax rate. Right. Again, no joy. So previously there was a universal rate of 19%, but now the government decided to put a rate of 25%. But again, that comes with a few things which are quite good. So the first thing is, so if your company has made profits of 50,000 and below, you'll still pay tax at 19%. And if your company has made tax profits above 250,000, then you will pay tax at 25%. And if your company made tax profits between 50,000 and 250,000, then a marginal tax rate will be applied to that profit, which is quite funny because this used to be how things were, where there were use of different corporate tax rates, and the government decided to do away with it and decided to have one universal tax rate. And this was part of the plan of making tax simple. But now it's quite surprising that we now have these marginal tax rates which have been introduced, which again confuses people because it makes things complicated. But at least now the good thing is there's relief for small businesses, which is a good thing. I mean, that's what they were trying to do there. If you have made profits of less than 50%, you'll still be paying tax at 19%. So that's a good thing. But again, the 25% corporate tax rate is quite high across many developed economies. So I think that is likely to be reviewed at some point in the future. But again, that depends with the government that is going to come into power next year, whether the Conservative or Labour. Right, help to save scheme. So in the training, I didn't cover this saving scheme or this product. So the help to save scheme is a benefit or a product that people who are receiving universal credits or receiving other government benefits, they might be able to utilize. And the way that it works is it allows you to contribute up to a maximum of £50 a month, and then you get a government bonus of £25. So this allows you to save up to £50 a month, and the government will pay a bonus of £25. And the way that it works is you have to open an account through NS&I, which is government-backed company. So once you've opened that account, then you have to keep the account open for 4 years, and at the end of the 4 years, the product will expire, and then you'll be paid the whole amount that you have contributed. Okay, so this bonus is paid on year 2 as well as on year 4. And the good thing, so this is a good thing if you're eligible, because on a year you can contribute up to £600, and then on that £600 you'll get £300 being added to your account, so that's £900. So over the 4 years, if you decided to utilize the full 4 years, then you will be able to make £3,600. That is on top of your contribution of 2,400. Then you also get 1.8 as a bonus from the government. So I mean, if you are eligible, just check out this scheme to see if that can help you to boost your savings or your savings goals. Okay. And the next thing, good news for aspiring homeowners. So if you're planning to buy a home for the first time, there's a new product which was launched by Skipton Building Society on 9 May 2023. And this brings back 0% deposit mortgages. So these used to be there before the financial crisis, before 2007, 2008. So they used to be 0% deposit mortgages. Okay, and these were scrapped. And previously you needed like 10% or 5 to 10%, depending, of course, on your depending on the lender. But in most cases it was 10%, unless maybe if you're using a government scheme where like one of the schemes that we'll cover briefly later of the mortgage guarantee scheme, where you could raise 5%. Okay, so the way that this works is you could be eligible to get a mortgage to buy a house without any deposit, but of course there are some eligible requirements on there. So to be eligible, you have to be a first-time buyer, as you can see, and so I just grabbed this from their website, and your age is so 21 and above, having a deposit less than 5%, and you should have proved that you were a tenant and you have been paying, you have experience in paying your rent as well as rents. So if you think that you are eligible, you can check this out. But again, Skipton is not one of the top mortgage lenders, so there's likely to be competition on this product. And this information is accurate at the point when I got it from their website. So check this out if you think that you might be eligible. But unfortunately, because you are not putting any deposit, then the interest rate is going to be higher for the bank to compensate itself for the building society to compensate itself for the risk that it's taking. Unfortunately, like at the present moment, as far as I know, it's only Skipton who had launched these products. But like now, the housing market is tricky, interest rates are high, so I don't think there have been a number of banks and building societies that have been willing to jump to the pond to also offer similar products. But good news is, seems there's some light at the end of the tunnel. Inflation rate is starting to come down, so hopefully when things normalize, maybe other banks will offer this scheme. And again, if you don't qualify for this scheme, know that there are also banks of moms, dads, grandmas, and granddads. So like some providers, they accept that either your parents or your grandparents or uncles who are rich or who would have made some who have some huge savings, they can put a fixed amount as a security, which allows you to borrow. And then what will happen is that amount that they put in will be act as a deposit or a security deposit, that is will act as a security deposit that has been placed with the provider for a specific period of time. And sometimes they can earn interest on it, or sometimes they don't earn any interest on it. And then after the end of the term, then they will be able to get the money back. And then, because at least you'd have built-in equity. So, I mean, so those are some of the options. That is, of course, if you don't have your own deposit, just check those out. And you can also speak to mortgage advisors, okay? Next, national insurance missing years. So, I didn't cover this in the training, and I think it's quite important, so I come across this information later on. So if you don't know, for you to be entitled to a full state pension, so like at the moment, the full state pension is £203 a week. So for you to be entitled to that, you should have been making national insurance contributions. And the minimum that you have to have contributed is 10 years. And then for you to be entitled to a full state pension, you should have made contributions for at least 35 years, okay? So what that means is, if you have contributed less than 35 years, but at least more than, so what that means is, if you have contributed between 10 years and 35 years, the benefit that you get is going to be reduced, okay? So in the online training course, I have actually shown in detail how that amount is calculated. But you don't really need to worry too much about it. You can actually view that on your tax account, okay? So let's say, so what the government did is, they knew that some people, let's say if you have taken like maternity leave, or maybe you were ill at some point, or maybe career breaks, or maybe you were not making enough money to be able to make contributions to national insurance, or you are self-employed where you haven't been making contributions. They have introduced a scheme where you are actually able to pay, which is contribute for those years, so that at least you can cover any gaps in your national insurance contributions, okay? So, and you do this by making voluntary contributions. And this only occurs for a 10-year period between 2006 and 2016. So if you have any gaps, then you are actually able to make voluntary contributions which will close those gaps. I will show you shortly how you can check your tax account to see if you have any gaps. Because so I've said that you'll be earning about 200 pounds a week if you have made enough national insurance contributions over the period, which is quite a significant amount of money when you are retired. So if you think that state pension is going to be necessary for you on your retirement, it might be worth for you to check these things. That's why I have termed this course Comprehensive UK Personal Finance Training course, where I have tried to cover as much of the necessary information as possible. Okay, so if you log into your tax account, so use your government gateway ID, so you can actually search. Even on YouTube, there must be videos on how to access one. It's a straightforward process, so you need some information like your unique tax reference number and your pay slips and things like that. It's straightforward, and your email, of course, and UK phone number, so you can just go ahead, open your account. If you have already an account, log into your account, and then if you go to the national insurance section, it should be able to show you. So this is my account on there. So as you can see, so far I've made 8 years of full contributions, and I will need to contribute for the next 32 years before the retirement age. Okay, and as you can see, for the past few years, because I've been working full-time, I've contributed enough to cover those years. Okay, then 2023 to 2024, there isn't any record because I haven't been working. Okay, because I'm on full-time education. So I think this is quite necessary if you think that you will need state pension, because what you don't want is to reach state pension retirement age and then to find out that maybe you were actually thinking that you'll be earning 200 pounds like at the present moment, and then to discover that you are only going to be earning less than that, or even nothing if you haven't been making contributions. That will give you a lot of stress. So I would advise that if you think that you haven't been making contribution, let's say if you have been self-employed, or there were some issues which stopped you from working, as I mentioned before, go ahead and just double check to make sure that you are on track. Okay, if you need more information, you can search on Google, and then so these are some of the contact numbers where you can just ring and find out more information on how to go about this. Okay, next, housing schemes. So extended housing schemes. So if you live in Wales, so the Help to Buy has been extended, which is a good thing. So it was supposed to end this year in March 2023, but it has now been extended to March 2025. So if you're in Wales planning to buy a house, check out this scheme. Okay, and good thing is the maximum value of the house has also been increased from 250 to 300,000, which increases options available. Okay, then next thing is mortgage guarantee scheme. So that one is ending. So again, the good thing about that scheme is if you have 5% deposit and if you meet the eligible requirements, the government will provide a guarantee so that the banks and building societies will accept your application and give you the mortgage. Okay, so that is ending in December 2023. So if you're planning to buy a house, and if you think that you won't be able to raise a significant amount of deposit, I think it's also good for you to check that scheme out. Okay, next thing, retirement planning. Okay, so good thing is the state pension, as we discussed. So that was increased from 185 to 203 pounds by 10%. So because there is a triple lock that I will cover shortly, where the government has to keep on increasing the pension based on the inflation rate. Okay, I will discuss that in the next section. So we have covered the annual allowance in terms of the reliefs and allowances on pensions, and also the lifetime allowance. So that 1 million there, it has just stayed just as a measure of determining that 25% amount that we discussed before when you reach your retirement age. Okay, right, then I came across this article on Financial Times, which I think is quite necessary as well. So from this article, what they are saying is most people, they will need about 100,000 So that's 99,500. So which is 100,000 for their later life expenses. So these covers your last years. I mean, it's quite depressing, but I mean that's one thing that is going to come to any of us. Okay, so they have estimated that for your last few years before you die, you will need at least 100,000 to cover your expenses. And and this is based on a 3-year period where you will need a lot of care. So let's say in a nursing home or a care home, or maybe you need a live-in carer to provide care services for you. So most people will need like 30 months. Okay, so that's 2.5, which is near to 3 years, as I've mentioned. And they have actually calculated that based on an assumption that you need £750 a week to pay for a carer who will be looking after you. You actually have to think about these things. So that's why you have to take control of your finances. So I mean, as you can see, that amount is quite high. So your state pension won't be able to foot that bill, $750 a week. So your whole state pension will be out. So for you to be able to raise that amount, what they've done is they've also come up with some contributions that needs to be made. Okay, assuming that you are getting a 4% return on a yearly basis. So if you have to contribute over 5 years, then you have to be putting 1,500, and then over 20 years you have to be putting £270 a month. So what that means is you have to think about these things and make sure that you have enough pension or enough assets, be it properties if you want, or maybe a business, that is if you have done well, or or savings, ISAs and things like that. Okay, then if you are going to put a lump sum, so let's say if you put 4,800, that will has to be invested for 20 years, earning 4%, for you to be able to make 99,500 pounds, which is 100,000. Okay, so I mean, I've just put this in just to as a reminder, so that at least you know these things, and then so that you can start thinking about them. Okay, next thing is again, I came across this article on Manweek. So this is a free thing. You can just go ahead, and I'm not earning any commissions or what, so you can just go ahead, subscribe, put your email address, and then they'll be sending you 2 updates, one in the morning and one in the evening. Okay, so I came across this article, which is also useful for retirement planning, based on an independent review that was done on the state pension age. What they discovered is for the government to keep on being able to meet pension payments, 2 things needs to happen. One is scrap the triple lock. Okay, so what is the triple lock? So the triple lock is the government has guaranteed that they will increase the state pension amount by the higher of either 2.5% or the inflation rate. So that's why, like recently, the inflation rate was high. That's why they decided to increase the pension by 10%, because that was above 2.5%. Or alternatively, increase the retirement age to 74 years for those currently aged 30 years. Okay, so I mean, we don't know what is going to happen, so there are likely to be some changes. As we can see now, the retirement age is going to be increased over time from 66, and it's rising to 67 in 2028 and 68 in 2046. Okay, you can actually check your retirement age on your account. So and you can actually Google, like, check state retirement age. You just put in your date of birth, and then it will give you your retirement age. So what that means is the retirement ages are likely to be increased, which is when you'll be eligible to get state pension. So that's why it's important for you to make sure that you also have other avenues if you're planning to retire early, or your savings, or other investment or things like that, so that at least you know that you have something. So this is why I created this course, to make sure that you have all the tools that you need to make some of these decisions. Okay, and also the increases in retirement ages are also going to be occurring on private pension as well. So if you're planning to access your pension early, there might be some changes, but the good thing is if you have made some savings, then you might be able to retire early and enjoy those savings before you can utilize your before you can actually access your private pension. Okay, right. Next, portfolio diversification. So in the training, I wasn't specific enough in terms of the number of shares or assets that you need for you to achieve reasonable diversification. So I researched about this a little bit, and from the research that I did, you need at least 20 to 30 stocks, which are different stocks, different sectors and things like that, for you to achieve a reasonable diversification. And from 10 stocks of different sectors, which have different risks, you would have achieved a reasonable diversification. So that's why, like funds, some of the funds are already diversified, so they give you the diversification element that you need. And so now from 10 stocks onwards, you would have achieved a reasonable diversification, and you can go up to 20 or 30. Above that, then diminishing returns will start in, where the amount of work that you need to look for another stock, it's actually higher, as in the cost is higher. That's more economics. The cost is higher than the benefit that you actually derive on diversification. Okay, so if you need more information, you can actually research more about this. Okay, and in the training I cover this in detail. Right, next, childcare scheme. So apart from what I mentioned, which are changes coming in next year, there haven't been any changes as far as I know. Right, next thing is loan sharks. So in the training, I talked about loan sharks and why you should stay away from them. So loan sharks are people who provide finance who are not regulated by the FCA. So in the training, sorry, I keep on referencing to the training. So in the training, I actually specify in detail how to check whether a loan provider is regulated or not. So if someone is not regulated and they are providing loans or debts or money, then they are loan sharks. And the bad thing is, once you have borrowed from these people, they charge a higher rate, and also sometimes they take illegal measures to recover their monies if you have failed to pay them. And unfortunately, these people, again, they don't do an affordability test where they assess whether you'll be able to repay them back. So that's the danger, where if you just approach them and you say you want 1,000, they can charge you like 50% and say, please pay me 1,500 in 3 months. Okay, they don't check, they don't check to see your finances, how you are doing, or your credit rating, or things like that. They just give you the money, and later on, when they want their money, they can even threaten you. So unfortunately, there has been a rise of these people. So from this article that came in on 28 June 2023 from Fair for All Finance, so they actually did a research. They noticed that about 14% said that they knew themselves or someone within their household had borrowed from these loan sharks. So please stay away from loan sharks. Otherwise, you'll be in trouble. So these are some of the articles that came at the back of the Fair for All Finance report. Okay. So these people, they're saying that they can approach you in cafes, in restaurants, or salons. Okay. See, because of the current financial crisis, that's why these people have been approaching. Okay, so let's move on. Right. Again, just to warn you to be careful. So, right. This is one of the courses that I like, that I put in the training, which says that the challenge with capitalism is that the things that breed trust also breed the environment for fraud. So this is by James Srowicki. Okay, so AI is quite good, and there are unlimited possibilities on what it can do. So like now, it can actually create videos, it can do art, many things that it can do. But again, that has also created a room for fraudsters, so they're actually taking advantage of the good technology. Okay, so if you watch this video, which was done by Wall Street Journal, called "Challenged My AI Clone to Replace Me for 24 Hours," just watch it. You will see what AI can do. Okay, so now because of that, now the fraudsters are now taking advantage of that, and so you have to be watchful for some of these type of things that they are doing. So like deepfakes, where they create a fake video or audios. So there's actually a video where they cloned Martin Lewis. If you follow the news, or if you follow his, I think it should be Radio 4. If you follow that, you should have heard him complaining, where they cloned his voice and also his face, and generated a video where he was encouraging people to invest in a financial product that had been launched by Elon Musk. For someone, that should have been sounding very suspicious, okay? So if anything is too good to be true, it is. So be careful. Don't just believe everything that you watch on the social media, Facebook, be it TikTok or Instagram, or where someone famous is promoting a dubious product, okay? And also ChatGPT phishing. So the good thing is now people who are not good at writing English, they are now actually able to go in and ask ChatGPT to draft emails for them. So like in the past, when I was doing training, when I was in audit, one thing that you could identify that an email was suspicious was by grammatical errors. Because most of these people, they are not really good at writing proper English. So an email would be stating that it comes from a popular organization. But then when you are reading, you can see that the English is not very good, and sometimes some spelling mistakes, grammatical errors, and things like that. So you could actually use those to identify whether something was unusual or not. But now, because of ChatGPT, they can actually ask it to write proper emails, so just be careful on some of those nice emails, okay? Then voice cloning. So this is when, so if you watch that video that I mentioned, you can actually see the AI cloning someone's voice, okay? And so sometimes if you receive a call from claiming that it's someone, and then they're asking for money or telling you unusual stuff, if possible, just drop the call and then call that person again. Because like it happened in the US, where a mother was called by someone claiming to be their daughter, that they were in distress and they wanted money. Fortunately, at least the person was aware and they didn't send the money. So, but it was something that they could have done, or maybe some people have already been tricked. Okay, so just be careful when someone calls you pretending to be with a different number, saying that they are someone that you know. This can happen. And then verification fraud. This is when AI is being used to verify that they are someone. Okay, so if you watch that video which I'm talking about, it will like give you like what AI can do. Okay, on that video, that lady there that you can see, banks, some of the banks, they have used voice verification, right? Where you call them and then you just say your name, then the bank will be able to like verify, ask you a couple of questions which are automated, and then they'll say verification completed. Then you can go and do something else. Okay. Now, because of AI, they're actually able to claim my voice, and then if they know that I bank with this bank, they can actually like call and be able to get through. Like that lady there, she actually used the AI generated voice, and the bank actually authorized. The bank actually verified their voice. Okay, so this shows how dangerous these things are. So just be careful and keep yourself safe, so that at least you protect all your savings that you have made. Okay, let's move on. Pension dashboard. So this was supposed to be released this year in August, but unfortunately this has been pushed to October 2026. So pension dashboard, what is it? So a pension dashboard is going to be, once it's live, it's going to be very useful for people, because like now most people, they are hopping on different jobs over a lifetime. Gone are those days where people would stay at one company for life. So like now people change jobs frequently. So the disadvantage of that is that once you join a company or another employer, they'll put you on their pension scheme, and then you move on to another employer, they put you on another pension scheme of theirs, and then you move. So imagine if you have changed 10 jobs or 20 jobs over a lifetime, you might be having 20 different pensions. And where do you start? How do you track those? So the good thing is, once this dashboard is live, once you have logged in, you'll be able to see all your pension funds on one go, on one place, which is good, because at least it ensures that your pensions don't get lost, because there are quite a number of pensions that get lost, and they end up being claimed by the government once someone is deceased because people fail to track them. Okay. But in the training, I've actually gave a lot of information in terms of how you can claim those pensions. Okay, let's move on. Right, last thing, exciting. Okay, so there's this documentary which I've decided to share here, which I think will be useful to you. It's called How to Get Rich, of course. So the title there is a bit catchy. So if you are someone who is suspicious, it might not tempt you to watch it. But I mean, this documentary is quite useful. So it was done by a guy called Ramit Sethi. So he's based in US. He's one of the personal finance champions on there. So he has done books and the like. So he helped a lot of people with personal finance issues. And it was quite insightful because it actually gives live examples of people who are struggling with their finances, some of them who have debts, or some of them who have habits of spending, and quite a number of people facing different financial problems. And then what this guy does in the documentary is to actually come up with plans and help these people so that they can achieve their financial goals. And it's quite insightful. It's not about you accumulating significant wealth, but it's actually about you coming up with what your rich life would look like. So of course, finance is a part of it, but in terms of what you want to do and where you want to work, and the other things that you'd want to do with your life. So it actually opens up in terms of how you can think about those things and how you can come up with some good goals. But now, once you've watched this documentary, if you have time, which I highly recommend, is you can buy my training, because that's where I will show you the tools of how to achieve some of those things that Ramit talks about in the training. Okay. So lastly, this is the training again. So if you're watching on YouTube, there is a link. There's a link below where you can just click. That will take you to the course. The good thing is Udemy sometimes offers some promotions, so you might be able to buy it at a lower price than what you see on your screen. But again, £20 is not that much in terms of the benefit that you will derive out of this training. So yeah, it's up to you. And just a disclaimer before you go. All the information that has been shared in this training is for educational purposes only. It's not financial advice. And if you are planning to use some of the products that I've mentioned in this training, you need to do your own research. And in some instances, you actually need to hire a qualified financial advisor. They'll be able to help you with these things. So this is just for educational purposes only. I'm not recommending any of the products at all that I've mentioned in this training course. And again, finance is risky. There's a higher chance that you may lose your amount that you have invested. Let's say if you decide to invest on anything, if you are not, it's risky, you might lose some of that amount. Okay, so you need to be careful and make sure that you know what you are doing, or use the services of a financial advisor to help you. And that's it from me for now. Don't forget to subscribe to my YouTube channel, because I'll be sharing similar updates as time goes on. And lastly, if you like the contents, you can also check the training and see if it's something that will be useful to you. I hope to see you soon. Remember, learn, invest, and build wealth. Bye for now.